Rohr here with an early global view on Tuesday, September 9th, 2014. It's currently a little after 7 a.m. U.S. Central Time. And the macro factors are a little lighter this week. It's that post-U.S. employment relative data vacuum. So what does all this mean for the U.S. and other markets? Well, we'll start with the short-term view of the S&P 500. This has been a real churn. You're seeing the hourly chart on the left, 30-minute on the right, with indicators below. And ever since the market gapped up and got near the 2,000 area a week ago Monday, last week was a real churn. And Thursday of last week, the market had some overnight pressures that put it down into the 1990 to 88 area, right into the low end of it. That was an old false down break and important previous congestion that the market would need to get below in order to look like it was rolling over to the downside. Well, even in spite of the pressure on Friday, and it was actually pre-opening on Friday, before we even saw the first hour, that weak U.S. payrolls number had already had this market down into 90 to 88 range, and then in the morning, after regular trading hours started, it got back into the 1990 to 88 range and just couldn't break it. And to us, the undershoot on the U.S. non-farm payrolls, which is considered such an important number, not bringing a failure below that level is a sign that the central bank accommodation is winning out against some of the concerns about geopolitical disruptions and an unsettled situation, and even the weak European and Japanese data, if the central banks are going to be more accommodative because of it. And what we have here is a market now where the higher resistance, of course, is around the trading high, right up into near 210 to 2010 or so. This support, 1990 to 88, remains, while there's a Fibonacci level right now at 1982. The bigger lower support is into the 1975 to 78 level. Very hefty congestion from back in July on the S&P 500 future, before it overran it on the way up. And the resistance is up around, give or take $1, up around the 2020 area. And the reason that 2020 is the, again, general area is that's where the topping line on the weekly chart and the oscillator come in. But first, there is the question, will the bears find a way to get this market back below 1990 to 1988? And that pretty much does it for the short-term view because there's not much happening on the indicators.